Good morning, traders. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. And for this edition of Trade Talks, David Weisberger, he's the head of equities at ViableMkts, joins me for our monthly market structure solutions update. David, as always, thank you for joining me at MarketSite. And of course, a lot has happened since July. What are the latest themes that we're focusing on now when it comes to market structure?
Well, I've been writing a daily blog these days, and so there have been quite a few things to talk about. I think the two biggest issues all revolve around one central theme. One issue is the rebate debate, and editorials and otherwise claiming falsely that rebates are kickbacks or somehow untoward in the market to try to scare individual investors. And the second is issues around liquidity and what would happen whether rebates are gotten rid of and how institutions can interact in the market. And one of the more interesting developments is Nasdaq's recent filing for a midpoint extended life order, which deserves comment, and that dovetails with many of these other issues. And by the way, thank you very much for having me.
Of course, as always. This is my favorite conversation of the month to have, by the way. So let's talk more about the MELO, as we affectionately call it here at Nasdaq, which complements our PSX as well with the whole price and size priority. Go into a little bit more detail about that.
Well, the issue really is institutions have a need, and that need is fairly broad-based to trade larger blocks of stocks that at any instant in time are available on the displayed markets. So you've seen all sorts of adaptations and innovations in the industry. One famous adaptation is IEX's dark pool, which uses a speed bump to try to make sure that when an institution is placing an order in their dark pool, that it's always at an advantageous price, i.e. they're capturing the spread. Now that's great for price-sensitive investors, but of course it causes them to miss liquidity because they don't trade as much as they would if they just stood there. And the reality is, if you go back in time to quite literally 15 years ago, 20 years ago, institutions pretty much never captured the spread. They always had to pay the offer. Even when they put a limit order out there, they had to wait for the offer to meet that bid in order for them to trade. So the idea of institutions being able to capture spread is a thing that's developed as the same time as high-frequency trading happened, i.e. decimalization and the speeding up of the markets and order-driven markets. But with all of that, many traders will tell you that they've lost something. Now, what have they lost? Well, they've lost a little bit of the ability to trade in a larger size because market makers today put little bits up on the market. A lot trades. In fact, volumes did go up by a factor of 10 in this whole evolution over the last 20 years. But they lost the ability for immediacy. There are multiple ways of getting at that. There is using dark pools as a general way. There are competitive products such as Coda Block Auction, which is to go get it. And Nasdaq's new innovation is very interesting. So what they've said is, okay, if you're willing to place an order on our exchange in the dark at the mid, and you're willing to let it sit there for half a second before it becomes eligible for trading, then it can trade against another person who might be on the other side who's also willing to let that order sit there for half a second before trading. That indeterminacy of time, which is 500 milliseconds, which
in trading is a very long time.
Well, it's a long time for knife-edge, high-frequency traders. It is not a long time for a human being. And what it means is it is a way for human being to meet human being in the dark. And frankly, it's a very clever way to do what people in this market call segmentation. So segmentation can benefit investors when it is tailored to their needs. So retail investors, I've written about often, have benefited dramatically by segmentation, despite various commentators off on the side who make literally silly claims about retail being taken advantage of. The fact is, retail trades inside the spread enormously today, and their costs have done this, and now they've more or less been leveled off. But the fact is retail has been one of the big beneficiaries because their flow gets segmented to wholesalers. Institutions don't have a whole lot of segmentation. This is a way for institutions to have their flow segmented. It will only interact with other people with the same investment idea, which is, I'm willing to wait for half a second. And so it's not segmentation by saying only institutions, only hedge funds, only this. It's segmentation by whoever is willing to be price indeterminate for half a second. And that sounds really geeky, right? I can't help it, I'm a geek, I know that. But the reality is, if I'm a human trader sitting at a keyboard, this is a really interesting way for me to try to find liquidity that matches the way I trade.
And that's what I was just going to ask you. This is a natural way of producing that liquidity, because that seems to be one of the larger issues in the market structure conversation is liquidity. So rather than having to go out, whether it's an exchange or a dark pool, and you're sitting on the bid as they continue to drive up prices, as you mentioned before, if you just go in with the size, that's where you're going to get your liquidity from.
Yeah, sometimes. I mean, look, the fact of the matter is you're right. But the market is very complicated.
Right, it's not a one-size-fits-all type of solution.
Exactly.
And I think that's where, from a regulatory perspective, if I may be so bold to say, that's where we're getting stuck, right? We're looking for this one-size-fits-all solution when we have the most complex, advanced markets in the world, which we'll get to later. But my question is, why are solutions so complex that are being presented? Isn't there a way that we could potentially do this without being so disruptive?
Well, complex and disruptive are two different things.
Right.
The answer to, could we do this without being disruptive, is emphatically yes. The answer is, can we have a market that is less complex and achieve what we want to achieve? The jury is out. I tend to doubt it, because there are, if you really get down to it, there are hundreds of different types of investors and traders that are all interacting. And it can't be lost that the competitive nature of the US markets essentially has evolved better from objective measures such as percent of market cap traded, overall spreads, et cetera, to fit all of those people. And the fact that Nasdaq can come out with an innovation, or other, some of your competitors come out with innovation, or even IEX came out with innovation, is a good thing. And we should be encouraging that. So I get troubled by these one-size-fits-all pronouncements like ban rebates. When I hear ban rebates, my brain actually hurts, because rebates are used by two broad classes of investors. Broad class 1 are agency brokers on behalf of institutions. Broad class 2 are principal traders and market makers, people trading for their own money. In the class 2, there is zero conflict of interest with rebates. They are pure and simple an incentive to provide liquidity.
Right.
Getting rid of them decreases liquidity. It's pretty much ABCs, 2 + 2 = 4 level stuff. The agency problem that has been discussed is real and absolutely can be handled and maybe even measured with a maker-taker pilot. But if you don't look at things such as routing behavior and opportunity costs, you won't know. And so my answer is better disclosure, pass-through of the rebates is a better way of attacking that, because the unintended consequence of harming liquidity is very, very real. And Nasdaq was quite bold, actually, by unilaterally doing an experiment by cutting rebates, which more or less proved the impact on liquidity as well as the impact on behavioral changes. Unfortunately, since nobody else followed them at the time, we didn't get a broader, full market view of it. But I think we know enough to know that a maker-taker pilot cleverly put together and measured appropriately will have some interesting results.
Right. So actually I want to throw in another Nasdaq term that we use here, Project Revitalize, and part of that a project is looking at American companies and letting them know they have an edge with the access that they have with U.S. markets and access to the broad capital markets that we have. And I think we need to celebrate that, and I think we need to discuss that more versus just looking at a one-size-fits-all type of model, or just looking at the complexities when these complexities lend to this vast market that we have.
Yeah, it's really funny that you mentioned that, Jill, because one of my big pet peeves in market structure is so many people focus all their effort on trade-weighted analysis that, by definition, looks at the top 20 to 50 stocks overwhelmingly. So everyone is concerned with market structure in Bank of America, Sirius Satellite Radio, the SPYs, the Qs, the ETFs that are the flavor of the day, GDX, et cetera. When you do symbol-weighted analyses, and even if you can cut them by different weights and different trades, you get a very different picture. And market structure should be to encourage the monopoly of companies in the United States, whether that be the small emerging growth companies to the mid-cap companies. Market structures that fit those companies will be different than these. So broad prescriptive changes such as, I sound like a broken record, banning rebates is really bad for those less liquid companies. In fact, we should be looking into potentially allowing rebates to be even larger for stocks that have spreads that, as part of the pilot or whatever, spreads that are much, much wider. because we have this entirely complex market.
Right.
And that is a problem. And solutions for that are going to look different than solutions for Bank of America and the most liquid stocks.
All right. Well, thank you very much, David, for joining me as always. And traders, thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.